Hello, everybody. Welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us today. So today we thought we'd talk about the fact that markets actually can go down. If you've looked at your September statement, you'll notice that we saw volatility in the month of September and so far in the month of October. And stocks are actually off their all-time highs. Not a lot off their all-time highs, but they are actually off their all-time highs. September was the first month in quite some time where we saw both the stock market and the S&P 500 and the bond market, the aggregate bond index, so the S&P of the bond world, both lose money. And so asset allocation for a lot of people, not our clients, but a lot of people, didn't really work so well last month. And so people are saying to themselves, well, what's going on? And so today we thought we'd talk about the dynamics that is creating some of the volatility in both the stock and the bond market. So first off, obviously, unless you're living under a rock, you realize that there is much more inflation in the system now. The numbers, the CPI numbers that continue to come out. Last week we got another CPI print that was higher than expected. And so everybody is feeling inflation, and there's lots of reasons for what's going on with inflation. Some of it will be transitory, but we believe that some of it's going to be here for quite some time at a higher rate. And so why do markets worry about inflation? Well, historically, inflation means that interest rates move higher, and we have seen a move higher in interest rates. It hasn't been a huge move, but it has been a move higher. And there was a big part of the stock market specifically that has what we call duration risk, meaning these are companies in the generally technology space that are dependent on the zero cost of capital. They're growth companies and they're not making money, but somewhere out in the future, I guess the market thinks they're going to make money, but they are very dependent on very low interest rates. And so that part of the market has certainly sold off more than, say, the Caterpillars, the John Deeres, the Nikes of the world, the companies that actually make money and make things. And so the other part of the market on the bond side, longer duration assets, so bonds that mature well out into the future, have also sold off as interest rates have gone higher, because bonds and interest rates have an inverse relationship on prices. So if interest rates go up, bond prices go down, and that's what we've seen in the bond market. So what do we think about going forward? Well, I think inflation is here to stay. The Federal Reserve next month is going to start to taper their bond purchases. They're going to reduce their bond buying by $15 billion a month to the point where they get to zero. And so the biggest bond buyer in the market right now is going to go away. So that could have an impact on interest rates moving higher. And then at some point, the Federal Reserve hopefully is going to raise interest rates, all of which is going to be a headwind for risk assets like stocks and house prices and all of that. And so because markets are forward-looking, markets have started to anticipate that. And so that's why we've seen some volatility to the downside in both the stock and the bond markets. Now, we don't know that absolutely that's going to happen. There's a million different things that could happen, because a lot of you probably say, well, if we know interest rates are going higher and stocks are going to go down, shouldn't we do something about that? And the answer is no, because that would be timing markets, and we're never going to get that right, because a lot of other things could happen that could change that narrative where rates do not go higher. And so the only thing that most likely we will be doing is rebalancing as part of our normal course of action with our client portfolios as our risk management tool. So the flip side of that, and where we've seen markets trade higher, especially this week, certain parts of the market, is earnings season has started. And so Josh can talk a little bit about earnings season and why that's been a catalyst to move markets higher in the short term.
Just to highlight, we're through the first week of earnings season. So historically, financials report first. All the money center banks reported this week, and the earnings have really knocked it out of the park. We're seeing S&P 500 year-on-year earnings growth in excess of 32%. Top line numbers growing near 15%. So remember, multiples were quite high, but with such prolific earnings growth, companies sort of grow into those valuations. And we've also seen sort of a retracement in rates. So multiples have actually contracted, hence likely the upward increase in stock prices. But another thing that I wanted to talk about is sort of the dynamics that have really driven small cap outperformance of late. And Tyler sort of highlighted some of that duration risk in earnings, but there's also been a resurgence in the dollar. And remember, if you're an international investor and you still have fairly significant negative real yields, you want to buy dollars when interest rates go higher. And so we see an increase in the dollar, which decreases the relative competitiveness of multinationals, and at the expense of more domestically centric businesses, which tend to be small caps. And so this last couple days we've really seen a resurgence in the small cap, and specifically small cap value trade, which we kind of anticipate to continue to outperform as the domestic economy continues to hum along. But we shall see. But the rest of earnings season still to come, though the markets seem to have a little bit more dour outlook than perhaps is being realized. So hence the upward increase in stock prices.
So, there's a lot of dynamics in play that is going to create volatility going forward. Seasonally, this is a volatile period, but with the inflation picture and interest rate environment, we are certain that that's going to create volatility. It doesn't mean any of you should be doing something dramatic. Remember, we make changes in your portfolio based on your life circumstances changing, not the market changing, and that's vitally important. So if you have questions about your situation or your account, you can always give us a call, 800-743-0988, or Josh or Tyler at northwestquadrantwealth.com. You can send us an email. We'll be back here in 2 weeks.